Here's a closing bell for today, May 10th at the New York Stock Exchange.
The closing bell on Wall Street. The market settling here after 3 straight days of heavy selling. You can see how things end up. A mixed picture here. The Dow closing off just about 85 points. S&P and NASDAQ, though, holding on to gains. Taking a look at some of the worst performers inside the Dow. IBM, that stock off nearly 4%. JP Morgan, 3M, Home Depot, and Caterpillar, the 5 worst performers there. Sector action, what Ines was just talking about. A mixed picture, the biggest selling coming in real estate, utilities, consumer staples, financials, and consumer discretionary. Let's break it all down with Omar Aguilar. He is Schwab Asset Management CEO and Chief Investment Officer, and Scott Brown, LPL Financial Technical Market Strategist. Scott, let me start with you. When we take a look at a day here, I guess the Dow just barely to the negative. Do you think we've seen the worst of it? Have we seen the extent here to the downside for the market?
You know, I think we finally started to see some signs of panic in the past week or so. Obviously, late last week and Monday, we think we made some progress, but we do think we're a little bit skeptical that we're actually at the bottom. It doesn't mean we have to go down a lot further, but a lot of the things that we look at, whether it's put to call ratios being really extreme, the VIX spiking up above 40, or just market internals, they aren't really as extreme as we would typically see at a correction bottom of this magnitude. So again, we're staying a little bit cautious here while recognizing that there's going to be a great opportunity in stocks at some point this year.
And Omar, you break down a number of factors, including risk aversion and fear dominating the market. What are you looking for in terms of signals as you're trying to sort of block out some of the froth and the noise in the market?
Well, we have gone in this market from fundamentals to being macro driven, a lot of focus on central banks and Fed. And I think the Fed just created just this sentiment market that we've been living now for the last week and a half, where, investors are still trying to digest the information that is released by the Fed. I think numbers like the one tomorrow on CPI will be critical for people to start to understand what the implications are of inflation, which is on top of everybody's mind, as people seem to think that inflation will be the determinant of how fast and how aggressive the Fed might go going forward. So there's a lot of those things that happen. So what we encourage investors to think is that, we're going to see more volatility. This is not going to be an easy, path forward, as we still have a lot of unknowns, and there's still a lot of uncertainty in many parts, not just of the macroeconomic and the economic structure, but also just geopolitically, things that haven't been resolved, like the war in Ukraine, as well as just the COVID situation in China.
And Scott, Omar references sentiment there. You like to gauge that with looking at the Barron's Big Money poll in terms of gauging investor sentiment. What is your takeaway from that?
Yeah, I think there's 2 main ways to gauge sentiment, right? There's the survey data, which is overwhelmingly very, very bearish. The AAII, biggest spread between bulls minus bears since 2009. Biggest money Barron's polls, everybody says their clients are very bearish. Then we look at what people are actually doing, and that's where we see some questions. Put to calls haven't really spiked. We just don't see all these signs that people are actually selling like their words would suggest. So that's what makes us a little bit cautious, but I think sentiment is still overall, it's a modest market positive here in a market where they're kind of few and far between positive signs.
Omar, if you're an investor looking to put money to work in this environment, still so much uncertainty, what we've been talking about over the last couple of minutes, what should investors favor?
Well, that's a great question. So to put it in perspective, this part of the cycle has been accelerated. So we have accelerated now going to the last pass of the cycle. Again, some of that is related to events that had nothing to do with our economic, situation in the U.S. and that had external, events that ended up getting us so fast into here. So defensive plays going into that, thinking that, the best case scenario for the landing is a hard one. And if you actually think that the probability of a recession is significantly much higher than anything that we have seen in quite some time, then, playing into that defensive, rotating into that defensive part of equities is currently, a part that normally has, companies with strong balance sheets, companies with high quality, companies that pay consistent dividends, usually tend to do well as you go into that, as well as the traditional, defensive utilities, staples, and so forth. On the fixed income side, that's when things become a little more interesting. We have, at Schwab is starting to think about the potential to slowly increase duration as we start thinking the fact that the rates will continue to go up. Still the credit market is still very strong, but certainly, as we go into this part of the cycle, trying to stay away from all the high yield component is something that we advise clients to just try to just reduce exposures on that kind of part of credit, while it's still, within the most investment grade, try to increase duration across their fixed income portfolios.
And Scott, the difference between selling right now versus panic selling. How much is that impacting the market? And what should people be rotating perhaps out of or into in this sort of environment?
Yeah, first of all, you never want to panic sell. You always want to have a plan. But we do think that for investors that have been in those speculative stocks that are not making money, we're really skeptical that the selling is over there. So again, maybe panic selling isn't the right move, but rotating towards more quality companies, as Omar just mentioned, those are the types of stocks that you probably want to own in this environment. And we really don't see the environment where you want to own those more low quality companies coming back this year, even when stocks do eventually bottom.
Omar, you talk about the likelihood of a recession increasing over the last few weeks, which certainly it has. How likely do you believe a recession is, or can the Fed pull this off?
It's great question. Well, if you go back in history and you look at the data, 10 out of the last 13 hike cycles by the Fed ended up in a recession. Now, this one, as always say, and the cliche sounds, this time is different because we started with a very, very low base. And therefore, the level that we have to 3% or 2.5% to 3% that is the target by the Fed may not be the same as any previous one. But the probability of recession is definitely out there. Now, the biggest challenge in here is that we have something that we haven't observed in many cycles before, which is inflation numbers are at 40-year high. So when you put into context the fact that a lot of the inflation numbers are actually something that the Fed cannot control, even though by the fact that they're trying to aggressively tighten, interest rates, they're trying to suppress demand, a lot of the inflation numbers that we see today is still, supply driven. So it is a little bit of a transition from supply to demand on inflation that will allow the Fed to be effective. That I think is just the reason why we believe that the chances of a hard landing and potential recession are much, much bigger than any time before.
Scott, let's take a look at commodities because oil has been one of the big movers, obviously, over the last couple of weeks, but to the downside over the last 2 days, falling again today. Now it's below $100 a barrel. How are you looking at the energy space and I guess any potential investment there?
Yeah, we think it's a really important question and a really important story to pay attention to because one of the kind of very unusual dynamics we've seen over the past years, we've seen a lot of dollar strength and we've seen a lot of commodity strength. And that seems like something that's probably unsustainable. Question, of course, is which one is going to blink? 6 months, 8 months ago, we probably would have been in the camp that it was the dollar that was going to break lower. But as the Fed continues to increase its hawkishness, as international central banks kind of stay a little bit more dovish, this dollar's pushing up towards 20-year highs, and we're starting to see cracks in the commodity space. So it looks like the dollar might be winning that battle. Oil prices, it's still an uptrend. Most commodities are still an uptrend, but it's something to watch for sure because we started to see some cracks and certainly action like you saw in the past week, whether it was copper, whether it was oil, is a little bit suggestive of maybe a change in trend.
Certainly a lot of trends to watch in this sort of environment. A big thank you to our markets panel there, Omar Aguilar, Schwab Asset Management CEO and CIO, and Scott Brown, LPL Financial Technical Market Strategist. Thank you both.